Hey guys, Mike here. So obviously Cathie Wood at Ark Invest, about once a month she puts, something out where she'll talk to an economist, usually from Piper Sandler, about their thoughts on inflation, where it's going, what they predict to be happening, the stuff about the Fed and what they're doing with their tightening, and companies' profitability and stuff like that. And for those who don't have 45 to 60 minutes to sit here and watch this kind of commentary, I like to condense it down for you. And so hopefully this video is no more than 12 to 30 minutes long, I hope, total. And so I'll try to get it down for you. And, up front, I'll just say I really, really appreciate the stuff they put out. I hope these two ladies are correct. Like, I really do hope they're correct, because it would be a big boon for obviously our personal pocketbooks, plus our investments as well, if they're correct. Let me know in the comments what you think as you hear this. And they're going to go over inflation, what the Fed's doing. I agree with them on the mistakes the Fed is making and have made. Also what's going on with inventories for companies. We heard a lot about this last week, what that means as far as how it's going to affect inflation, the dollar. And then at the very end, she says something which, we'll see if it happens. I always find it interesting when she brings up this kind of stuff, and we'll see. But anyway, if you get anything out of it, hit the like and subscribe button. I really do appreciate it. Try to share the video, guys, and I appreciate all your support at the channel here. And let's get into, she's talking about inflation and then the Fed raising rates and kind of what that's done and what it's going to do and where she sees it going from here.
It doesn't happen immediately. It takes time. It takes roughly a year to change behavior. And so we are right now in a period where the economy is already starting to slow. You've certainly seen that with a lot of company news where their earnings are starting to get hit, and overall economic activity is starting to slow. And now the Fed is starting to raise rates. That's very different when they last had a tightening cycle, which was back in 2016. They were raising rates into an accelerating economy, and that gave them a couple of years of higher interest rates without really disrupting the markets or economic momentum. That's not the case today. The economy is already slowing. Why is it already slowing? Again, because global central banks have been tightening for a year. You also have higher bond yields. You have higher oil prices. All of those things lead growth, and they are now in the prospect of slowing economic activity. And now the Fed is stepping in and raising rates. We would argue they're late, and these higher interest rates that they're putting in place risk creating financial strains. And in turn, we don't think the Fed is going to be able to raise rates as much as they currently suggest, say around 200 basis points, because between now and then, there's going to be clear signs that the economy is slowing, and even inflationary pressures are going to come down. So we will get another rate hike, most likely in February and probably even in August. We're not so sure how aggressive the Fed's going to be able to be in the fourth quarter, because we think by then it's going to be pretty clear both growth and inflation are slowing pretty significantly.
Yeah, Nancy, I'm also struck. The Fed is really focused on the U.S., but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well. That has an impact on the rest of Asia. So what they're facing is a recession, and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down. But it also means that some of them are tightening more because their currencies are falling against the dollar. So it's a bit of a vicious cycle. And as Nancy says, I agree with you, Nancy, we are not alone. Many people are thinking about the U.S. in isolation. We've already had 1 quarter of negative GDP, which most people brushed aside, saying, "Oh, that's a fluke." And I think that was a real number, and we should not dismiss it. So, agree with you totally, Nancy.
And I would agree with you that Europe is already in a recession, to be sure. And don't forget the strength in the dollar. To the extent their currencies are weaker, the strength in the dollar is actually another disinflationary event here for the United States. So that just further increases the odds that we can see inflation slow pretty quickly.
In the old days, in past cycles, many people thought that the dollar going up was the same as monetary tightening. It's a disinflationary force. And it's up 15% since the bottom, which is a huge increase for the dollar in such a short period of time and really hurts emerging markets.
Absolutely. The dollar going up means that our imports from abroad are going to be cheaper and just makes it easier. And at the same time, the dollar going up further hurts corporate profits.
And I don't keep up with the data over in Europe enough to know, but if you're watching this from Europe, Canada, wherever, is your country already in a recession? I mean, that's what's happening. I can absolutely believe it. And they're right about the U.S. dollar. I don't really study the dollar too much, but it has absolutely been skyrocketing, and it does hurt corporate profits. It does absolutely hurt other countries as well when it comes to the import-export business. And so, it's one thing in a way. I guess in a way we got that going for us somewhat. But anyway, let me know your input on that. The next one she starts talking about is these inventories, which we got to hear last week during the big retail earnings calls that, one reason they just got crushed because they ordered so much stuff, and a lot of the stuff was the wrong stuff. The consumers switched sentiment and started ordering different things and stopped ordering plasma screen TVs or, high definition TVs, computers, and all the big stuff, and started actually buying luggage and outdoor furniture and things like that.
What will companies do? How do companies deal when they have too many inventories? Well, as Walmart just said it, they're rolling back prices. So, Cathie, I don't know how long it's going to take the Fed to realize that. We think they're looking at specifically core CPI, and they need a string of numbers where core inflation on a month-to-month basis is something closer to 0.2. By core, I mean ex-food and energy, which is what the Federal Reserve tends to look at. And they want that to move down toward 2% on a sustained basis. We think they're going to get there because companies are already here in May starting to cut prices. We've already seen used car prices come down. They became too expensive. And so we think as we go through the summer, we're going to start to see these 0.2s, maybe not April, maybe not May, but as we get into June, July, we think we're going to start to see another shift down in inflation because companies have to get rid of all this stuff and they're going to start to cut price.
One of the things that would be interesting to know is, have we ever seen inventories, Target or Walmart, have their inventories ever increased this much? So Target's inventories, their unit sales were probably down. 3% was the dollar value, but in units, probably down. And their inventories were up 42%. So take away inflation, that's 30 to 35% on a year-over-year basis. I do not believe we've ever seen that before. And these are well-managed companies. And even with marking down in April, these are through April, their inventories were up 42%. Walmart's were up 33%. Home Depot's up 32%.
And so this kind of leads us into, what does this economist see as far as these inventories, the data that's been coming out, as far as inflation, what they see projected through the rest of the year, and what can we see by the end of the year? And they are definitely optimistic, to say the least.
What the Fed is looking at is what those readings do sequentially. And so that 0.6% definitely opened the door for the Federal Reserve to do 50 basis points and to tighten again, probably another 50 as we go into the summer. That 0.6 month on month is a very, very high number. They are looking for that number to move down towards 0.2%. And given the backdrop that we've just highlighted, we think that does start to unfold in the summer. Near term, hotels, airfares, unfortunately, may continue to go up. I don't know if you all have noticed, they're egregious. But again, this is a very different backdrop than 2021. The travel and leisure industry doesn't have that consumer with a stimulus check, with a lot of savings, with wages going up aggressively and employment very, very strong, income growth for the consumer. Nominal income growth for the consumer this year is down to 4%. Last year it was double digit, 10 to 17%. That gave consumers firepower for temporarily anyway, to pay higher prices. They don't have that today. So we're actually worried that consumers, I call it, you got a new, smarter consumer, that you may take a vacation because you haven't had one in a couple of years. But as far as really splurging on vacations, they're pretty much making it impossible because prices have gone up so much as your income has gotten hit significantly. That, along with the excess supply we have today, in all the goods. We do think there will be a sharp slowdown in inflation back down below 2% as we move through the end of the year.
And so understand that right there is actually way below what the Fed is projecting. They project it's still going to be over 4% by year end. She's saying by the end of this year, we're going to be below 2%. I mean, like I said, I hope she's right, but to me, that is so beyond optimistic, because you would have to have a huge turnaround in what's going on with these supply chains, especially fuel, for crying out loud. My God, like eventually energy has to peak and start to come down dramatically for that to ever actually happen. But, you know, hey, it'll be good for us, so I'm certainly not rooting against it. Let me tell you that right now. And then to end this, you know, obviously Cathie Wood is all about innovation, and she makes this comment, because they've been talking about it for a little while here, about us actually starting to make things in the United States again.
I think Nancy's idea of this reshoring, the manufacturing renaissance here in the United States, is going to be a boon for our country. It's going to hurt other countries, but a boon for our country. I think that's one of the reasons the dollar is going up. And I think that our productivity gains are going to be enormous, because, you know, we lost a lot of the industrial world to other countries. Now we can rebuild it here with state-of-the-art technology. And that's very exciting from a productivity point of view.
And of course, you would think we would start doing that after this nightmare of a disaster has seen what happens when you depend on one country to make probably the majority of your stuff. But also understand, you know, this ain't going to help with employment. She's not talking about actually human beings going into factories, making stuff like we used to, right? She's talking about automation, AI, machines actually doing the work, okay? And that'll help with productivity. And so, you know, it'd be great to do it, but obviously it sucks for employment. I'm sure maybe they'll invent some jobs or something. Maybe you'll be the lucky one that gets to sit in a booth somewhere monitoring these things, or you get to fix them. But it's not human beings standing on an assembly line or doing anything like that, okay? And so you got to make sure you keep that in mind. And so, you know, this is pretty much what they talked about in a nutshell. As you can see, I mean, these two are in lockstep, and it's a very aggressive agenda, or, you know, predictions they have that we're going to be below 2% inflation by year end. And, you know, it's because of the inventories and all that other stuff. And look, like I said, hope they're right. Be great for us if they were. You know, maybe the Fed's wrong again, because they've been wrong this entire time. So I don't really have a lot of faith in them at all. But, you know, this is what also people, you know, would think, like, if they can get, because there's two stories to talk about here. One is you got that camp, and then the other camp is inflation is sticky. It's not going away for years. Okay? And the truth is, neither camp knows yet. We're going to have to wait and see. I think when you get to year end, we're going to know, is this really sticky or is it not? Right? Because now the Fed has just started fighting it this year, right? Rolling off their balance sheet, doing stuff they should have been doing last year. And so we're going to get to see how sticky it is and how sticky it's not. All right? So hopefully you got something out of it. Hit the like and subscribe button if you did, guys. And I'll see you guys later.